So welcome back. Let us take another advanced option trading strategy, that is iron Condor. Now again I will be speaking very slowly and deliberately. Please hear me out patiently. Alright. So in the previous lesson we have talked about a straddle, and in that we have talked about the short straddle and also the long straddle. Short one was for the sideways market, a stable market, and long straddle was for the volatile market. And then we also discussed about the triangle. In that also we have discussed the short one for the sideways market and the long one for the volatile market. And then we talked about how a butterfly or an iron butterfly evolved from a short straddle. We saw that. Alright. Now we will talk about another strategy that is called as iron condor. Now this bird that you see in front of you on the screen, this bird is called a condor. It is a type of vulture which is found in the Andean mountains in the western edge of South America. Right? Now look at this payoff diagram of the strategy that we are going to discuss. Does this payoff diagram look similar to this bird? Just try to superimpose the bird on this payoff diagram and just think over whether it looks like that. This top portion here, the beak portion, and these wide wings. Does it look like that? So therefore, this strategy is called as a iron condor. The word iron again because of the protection or the safety which it provides. This is an iron butterfly and this is an iron condor. Alright, let us try and understand what is the difference or how an iron condor is developed from an iron fly. See what you did in iron butterfly, what you did. For the sake of simplicity, just consider on this particular screen the green color as call and the red color as put. Alright, so in iron butterfly what you had done, you had sold a call and a put at the ATM strike and received some premium. Because it was ATM, the premium was slightly higher. Alright. And then you had bought one call little out of the money, and you had also bought one put again little out of the money. And because you had bought the call and put little out of the money, you had to pay a small premium. So the difference between the two, the premium that you collected and the premium that you paid, the maximum premium that retained with you was $6. Okay, so that was the premium that you retained. Of course, your losses remain limited. To what extent, that's a different story, but still your losses were limited. Now in an iron condor, what are you doing here? Just listen very patiently. What are you doing here? You are selling a call little out of the money. Here you had sold at the money. Here you are selling a call little out of the money. Because you are selling it little out of the money, you are getting a small premium. Okay. Then you are buying a call further out of the premium. So because you are buying it a little further out of the premium, you have to pay a small premium. So the net difference between this 2 and 1, the net premium that you retain on this leg is $1. Alright, just try and understand the concept. And what you are doing simultaneously, you are selling a put slightly out of the money, say here at 90. And again, because you are selling, you receive a premium of $2. And simultaneously, you also buy a put at a little more out of the money. Now, because you are buying here, you have to pay a small premium. So again, the difference 2 minus 1, $1 is retained with you as the premium. Alright. So the maximum profit or the maximum premium that you get is $2. Got it? Again, your loss remain limited. To what extent? Again, that will be a matter of calculation. But here, your maximum profit was $6. Here, your maximum profit is $2. Alright. Now, what have you done actually? You were playing at the money. All your game you were playing at the money. In this particular case, you are playing little out of the money. So therefore, this profit zone has become little wider but shorter. Your profit has reduced, but it has given you more flexibility, more safety. Alright. So what is the difference? What have we done? What is the difference between an iron butterfly and an iron condor, or an iron fly and an iron condor? Here the maximum profit or the maximum premium that you could retain was 6. In this case, the maximum premium that you could retain was 2. Alright. In this case, the scope of profit was more, so the scope of loss was also slightly more. How much, that we have not calculated, because that will depend upon the actual price or actual, what trade you are taking. But because the profit is more here, the scope of loss was also slightly more. In the iron condor, here the scope of profit is less, just $2. So in a corresponding manner, the scope of loss will also be less here. Alright. So if you want to be aggressive, if you want to be an aggressive trader, then you go for an iron fly or the iron butterfly. And if you want to be a conservative trader, then you can go for an iron condor. Now you see, you must be thinking that this profit we are talking in terms of $1 and $2 and $6 like that. That is the concept which I am trying to make you understand. Ultimately, you will be dealing in the lot size. The lot size may be say 100. If you are in America, the lot size may be 100. So 6 straight away becomes 600. Alright. And moreover, you may not be trading in one lot. You may be trading in several lots simultaneously. But to understand the concept, I have taken these, the figures, the comparative figures to make you understand. So an iron condor is actually an improvement of the iron butterfly. Alright. You have seen how gradually we have built up from a straddle to a strangle, and then to an iron butterfly, and then to the condor. Okay. So what you are doing in case of an iron fly, you are playing at the money. In case of condor or the iron condor, you are playing out of the money. So you are more safe here, out of the money. But correspondingly, here the scope of profit will be more, the scope of loss will also be slightly more. But here, because you are out of the money, the scope of profit will be less, and the scope of loss will also be correspondingly less. If you are aggressive, go for an iron fly. If you are less aggressive, or if you are conservative, then go for a condor. So I hope the the strategies, whatever we have discussed, you have understood well. First we talked about the straddle, then we developed a strangle by strangulating the profit and providing more breathing space, and then we converted the straddle into an iron fly by limiting the losses, and then by further curtailing the profit and losses, we converted the butterfly into a condor. All right. Now, quite complex, quite difficult to remember. If you can understand the whole thing at the first go, then you are a genius. But normally, common people like you and me may not understand at the first go. We may require a couple of reading or watching the lesson a couple of times to understand and grasp the concepts in a better way. Okay. So we may have to watch these lessons several times. If you have not understood at the first go, just don't bother. It is okay. Alright.